What's up, world? It's your boy Ross Mac of Maconomics, and yeah, let's talk about it. Now, we already went over the reasons why a person might want to buy options. Now, let's discuss some actual option strategies. One, let's look at a covered call. Now, this is a very popular strategy because it generates income and reduces some risk of being long on the stock alone. Now, to execute this strategy, you purchase the underlying stock as you normally would and simultaneously write/sell a call option on those same shares. So if you own 100 shares of stock X, you can write a call where you receive the upfront premium and agree to sell your 100 shares if the terms of the contract are actually executed. Now, the trade-offs here is that you must be willing to sell your shares at the set price, which is the short strike price. Now, investors who use a covered call think the asset will either trade down, trade flat, or just not as high as the strike over the time of the contract and want to profit from the premium. Next, let's look at a protective put. Now, in a protective put strategy, an investor purchases an asset, such as shares of a stock, and simultaneously purchases put options for an equivalent number of shares. Now, here an investor may choose to use this strategy as a way of protecting their downside risk when holding a stock. Now, this strategy functions similarly to an insurance policy. It establishes a price floor in the event the stock price falls sharply. Now, investors who believe an asset will increase in value over time will use this strategy to protect their portfolio against short-term losses. Now let's look at a bull call spread. In a bull call spread strategy, an investor simultaneously buys call options at a specific strike price while also selling the same number of calls at a higher strike price. Both call options will have the same expiration date and underlying asset. Now, this type of vertical spread strategy is often used when an investor is bullish on the underlying asset and expect a moderate rise in the price of an asset. Using this strategy, the investor is able to limit their upside on the trade while also reducing the net premium spent, compared to actually buying a naked call option outright. Now let's look at a bear put spread, which is the opposite. A bear put spread strategy is another form of a vertical spread, but in this strategy, the investor simultaneously purchases put options at a specific strike price and also sells the same number of puts at a lower strike price. Now, both options are purchased for the same underlying asset and have the same expiration date. Now, this strategy is used when the trader has a bearish sentiment about the underlying asset and expects the asset price to decline. The strategy also offers both limited losses and limited gains.